Is it possible that everything we thought we knew about the relationship between inflation and interest rates is wrong, potentially even backwards? It's no secret that we are headed into an easy money environment, one in which we'll see lower interest rates, the government spending and printing more money, quantitative tightening by the Fed ending, and potentially even QE restarting. And we are seeing similar moves by governments and central banks all around the world, not just in the US. As a result, myself and many people have been saying we should expect higher prices as a result of this. But here I would like to show you a chart of the Federal Reserve's interest rates overlaid with the inflation rate as measured by the CPI. The blue line that you are looking at is the Federal Reserve's interest rate. It's called the Fed funds rate. Now, this is not the interest rate that everybody pays on debt. This is the interest rate that banks pay each other to borrow cash from each other overnight. But this is the interest rate that the Federal Reserve controls, and then other interest rates across the curve are influenced by this interest rate. Now, one really curious thing that I would like to point out to you is the time period in between 1960 and 1980. And what you'll see during this time period is that interest rates and inflation moved in lockstep. As the Fed was raising interest rates, inflation was rising. As the Fed was lowering interest rates, inflation was dropping. If we zoom in just on this time period, you can see it a little bit more clearly that not only were these moves basically in lockstep in terms of direction, but the Fed's moves on interest rates actually somewhat preceded the moves in interest rates. In other words, the Federal Reserve began raising interest rates right here in 1961, and then right at the beginning of 1962, inflation started following it up higher. Right here in 1969, the Fed stopped raising interest rates and then started reducing interest rates. And shortly after, inflation started moving down as well. Here in 1972, the Fed started raising interest rates. And later in 1972, inflation started following it back up. And then here in 1974, the Fed started lowering interest rates. And then later in 1974, inflation started falling as well. So we see a relationship that is almost exactly backwards from what most of us would expect. By the way, guys, what the dollar itself is doing in terms of its purchasing power for assets and goods and services is just going down. It's been doing that for 100 years now, and that is not changing anytime soon. So if you're interested in learning what my favorite way is to make money from the falling value of the dollar over the coming quarters and years, then on November 23rd at 7 p.m. Eastern time, this is in just a couple of days now, I'm going live to detail my trading strategy. And this is one that I believe will pay out big as the Fed moves to send its printers into overdrive. In fact, I've been using this strategy in my own account to generate double and triple digit returns on individual investments in a matter of months. This is not value investing. This is not asymmetric trading. This is not using margin. And we're definitely not touching bonds. This is in a different category altogether, the resource space. In fact, you've already probably started to see headlines like this about this space heating up already. And I think I have the perfect way to play it. Again, this requires no margin, no futures, no leveraging up your account. If you're interested in learning what my strategy is, exactly how I'm playing this, and how I've been playing this in my own account for over a year, click on the link in the description below to register to attend. It's free, spots are limited, so don't wait to sign up if you're planning on joining. Look forward to seeing you there. Now, in order to understand what is going on here, we have to understand what interest rates would do in a free market. And when I say free market, I mean a market that is not regulated or controlled by things like the Federal Reserve or the government. In other words, I mean a free market. And that means one in which the money is not imposed on the people and interest rates are not imposed on the economy, but they are freely chosen by all participants in the market, and that those prices are set by market activity, not by declaration or decision. Historically, money that people have chosen to use for themselves outside of government intervention has been gold. So imagine we have a hypothetical small economy with no market regulations, and they use gold coins for money. It's unrealistic given today, but this is to understand the mechanics of interest rates, so bear with me. In this particular moment where we're dropped into this hypothetical economy, let's say everybody has a ton of savings. They've got a bunch of gold coins all stored under their mattress. One person decides that they want to go invest their money and produce more goods to sell. So they're going to start spending their money that they have, but they need more. So they start going from door to door and asking anybody, if they're willing to lend their money to them. Now, at this time, everybody has a bunch of money. In other words, the savings pool is deep and large. So he is able to compare interest rates from all the potential lenders and make them bid against each other for his business, which means the interest rate that he's going to get to be able to borrow is going to be fairly low because he's going to go with whoever will give him the best interest rate. As he borrows, let's say at 1% and spends and invests, other people will notice this business activity and will realize, hey, now is probably a good time to borrow and invest because interest rates are super low. So everybody then starts spending and borrowing and investing. Well, as this money gets pulled into circulation through borrowing and spending and investing, it also starts circulating through the economy faster, which means people's incomes grow, but also their debt loads grow. As people's incomes grow, they're able to borrow more from each other. Eventually, though, this cycle has to come to an end because the amount that people have in savings will start to be dwarfed on average by the amount that people have borrowed, and the debt will have to start getting paid off. And the tipping point happens when eventually somebody goes to borrow and they realize, hey, I can't find anybody who has really any money to lend at an interest rate that I want to borrow at. If I want to borrow, I'm going to have to pay 6, 7, 8, 9, 10% because the few people who have any savings left are able to demand a higher rate because there's nobody left willing to lend. All of us borrowers are now competing for that money. And so the incentive in the system is now, hey, I don't want to borrow and spend anymore. I want to save and pay down my debt. And so that income starts to dry up as people take some of that income out of circulation, and instead of reinvesting it, they use it to pay down their debts. So when the savings pool has been depleted, the interest rate is naturally higher, which flips the incentive, and now everybody wants to save so that they can be the lender and just make money by saving and lending instead of having to do the work of investing. And that incentive drives money back into savings, which refills the savings pool. In a completely free market, usually this dynamic is distributed across different incomes, different wealth levels, different productions and different sectors and different industries. And those swings between the savings pool being depleted or being full are not very extreme because the incentives are always there in place, ready to counterbalance the system. Now, the relationship here between interest rates and the savings pool is pretty clear. But what is not as clear is what this does to prices. Because on the surface, you look at this and you can say, okay, well, because all the money is being spent now, it's being invested, the velocity of money goes up as everybody starts borrowing and spending, it is pretty clear that that should result in upward pressure on prices. Because all else being equal, you have more demand now for the same amount of goods and services. So that should drive prices higher. But the part of the equation that most people don't look at is that second part, the number of goods and services. Because when the interest rate is low and it drives that money into investing and spending, that increases production of goods and services. Think about every business out there when interest rates go down that roll over their corporate bonds, that borrow more, issue more debt, and they use that to hire people and they use that to do R&D. Think about all the consumers who borrow money to buy houses and cars and sometimes toys, all of that extra income going into the hands of corporations who use that to reinvest in their company in order to grow their profits and their revenues even more. And so it's really easy to focus just on the money side of things and just on the consumption, but that ignores half of what is going on. Is that when money is easier to borrow because it's cheaper, but that in and of itself drives down the cost of production, which drives down the cost of goods. Now, if we look back at this chart about the relationship between the Federal Reserve's interest rate and the CPI, we can see that the correlation between these two things that held up from the 60s through the 80s has not necessarily been happening for the last 20 years or so. The Fed was lowering interest rates from 2002 all the way through 2004, and yet the inflation rate started to pick up. And then as the Fed raised interest rates, eventually inflation stopped rising and started falling drastically into 2006 and 2007. And then once the Fed began lowering interest rates in 2007, the inflation rate picked up again. The most notable and recent example is when the Fed lowered interest rates to 0 after 2020. The inflation rate spiked to a recent record. And then finally, the Fed started to raise interest rates again, and the inflation rate started to fall. So the question is, why is there such a big difference between the last 20 years, that relationship between inflation and interest rates, versus what was happening from the 60s 1960s through about 1980? And the answer is that interest rates are not the dominant driving force in any of this. First of all, if you look at the United States government's debt compared to the size of the economy, it was falling from 1960 through 1980, and it was relatively low, bottoming around 30%. Compare that to the last 20 years where we've seen the debt to GDP ratio over 100% pretty much the entire time and near 125% today. In other words, the total debt load in the economy and the cost of servicing that debt is much higher than it was back then. Now, I can't find this data prior to 1980, but you can see that at least since 1980, the money supply compared to the size of the economy is much larger today than it was back then. So the economy has much more debt in it today than it used to, and a much higher money supply than it used to, which means changes to interest rates are going to have different effects on the economy because there are other variables in the economy that are also different. But despite that, it is absolutely true that if you are a company, if you are a business, whether you have a lot of debt right now or you don't have a lot of debt, if interest rates go down, it will be cheaper and easier for you to grow. And by grow, I mean produce more stuff in order to get more revenue and more profit. As you and your competitors all produce more stuff, supply goes up. So we can't just look at the money side of the equation. We can't just look at the demand. We also have to look at the supply of the wealth, of the goods and services that people want to consume. Now, I'm not making the case that the Fed lowering interest rates over the next couple of quarters is going to actually push prices themselves lower. Because again, that is not the dominant or only driving force. There are lots of other things at play. But the increase in production of goods and services is something that we should be taking into account when looking at where prices will go. And the flip side is also true. As interest rates stay artificially high, it is more expensive for companies to borrow money and spend money and invest in money. And in fact, the incentive for those companies is not to spend it. If I can get 5% risk-free by just sitting that money with the government, I'm not going to take the risk of trying to grow the business. I'm going to put it in treasuries and just wait until a better opportunity comes up adjusted for risk. And so the higher interest rates are, the more it stifles business activity and slows down the increase in the production of goods and services. And so if you're wondering why assets like stocks tend to go up when interest rates are dropping and tend to go down when interest rates are rising, this certainly has something to do with it. There's a big rotation going on in the markets right now, and specifically a few sectors that look primed to do the best over the coming years. If you're interested in learning my playbook about how I'm approaching markets over the coming quarters, don't forget to sign up for my upcoming event. It's in just a couple of days. Click on the link in the description below. I'm going to show you everything I know. As always, thanks so much for watching. Have a great day.